Hello and welcome to Mindful Money. I'm John Lappin, editor of Mindful Money, and today we're talking to Chelsea Financial Services' Darius McDermott about what investors should be doing in 2014. Hello Darius.
Hello John.
So could you give me first of all sort of a broad overview of 2014 and what you think that the prospects may be?
Yeah, I mean certainly GDP is really picking up in developed markets and sort of coming back in emerging markets, and the stock markets have actually followed. It's been a very good year for developed market equities, particularly the US, Japan and UK, and it's been a really poor year for emerging market equities. And you know, since the QE has been so strong in the last couple of years, stock markets have done really well, and we think actually it's time for a period of reflection. Not that we don't think we can still make reasonable money next year, but you know, we're not expecting sort of high 20% returns in 2014.
So if we look at the bond market in particular, should investors be worried? Should they be even avoiding bonds?
Yeah, I mean, sort of this has been one of the real obvious trades to avoid. It's not in any way contrarian. Everyone is saying we don't like bonds, and bonds have had a pretty average year this year. The expectation of interest rate rises, though, has been pushed further away. Both the Fed and the Bank of England have sort of said 2015, potentially end of 2015 for interest rate rises. And when that comes, I think bonds will be a real place to avoid. That said, bonds have been in a 30-year bull market. There really doesn't appear to be huge amounts of value. We would favour high yield bonds, sort of junk bonds, over government bonds certainly, because you do get that bit of extra yield, and we do think with the improving economic forecasts that defaults would stay low. So not really keen on bonds, but high yield bonds would be the preference if we were in that area, and people do need income.
And looking at equities more generally, you know, not a bad year at all.
No.
Do you think 2014 will be as good?
We would expect positive returns. The tapering news, which came from the US yesterday, actually showed positive equity returns, whereas when Bernanke talked about it in May and June, markets were very much spooked and fell for a couple of days. So I think now that there's some visibility and it appeared to have been sort of gently priced into the market, I think we could expect reasonable returns, and we do favour developed markets still over emerging markets, although emerging markets are notably cheaper than developed markets, which it's very difficult to say that developed markets are cheap at all now. They're not expensive per se, but they're certainly not really good value there.
And so what about the UK? So where the GDP figures are starting to look very good. You know, it's not everything in the garden is rosy, but it is miles away from talk of a triple dip and things like that, obviously, which we were discussing. So what do you think about the UK in terms of investors? What should they be looking at?
Well, I think the big change for investors in the last 12 months, and I think this theme will play through, is because obviously the FTSE 100 is a hugely overseas stock market. I mean, they're domiciled in the UK, but something like 70% of earnings for FTSE 100 companies comes from outside of the UK. And what we've been noticing this year is fund managers have been focusing away from emerging market exposure, more to domestic exposure, stocks that are actually benefiting from this GDP rise, things like EasyJet, William Hill, ITV, Howden Joinery. They're UK facing businesses, and it's managers that have been in those areas have had a very good 2013, and I can see that trend continuing, although again valuations are starting to look a little expensive in some of those stocks.
And emerging markets then, is next year their year? Or?
Well, emerging markets are cheap. And some of the bigger emerging markets, Russia, Brazil, China, they are sort of quite cheap against their own historic measures. But so I think you would get a valuation protection, but I can see little catalyst for actually driving emerging markets forward. Certainly money flows into emerging markets actually coming out, and that's both mostly driven by the tapering of QE. When the world prints money, it has to go somewhere, and a chunk of it has been going into emerging markets. That now I think is retrenching, and I do think it's hard for emerging markets to outperform in that environment. Also, with a strong US GDP, you could see the dollar being reasonably strong, and emerging markets historically do perform badly in strong dollar times. There's just a historic correlation there is. So whilst they are cheap, and I would not put anybody off buying emerging markets for the long term, if you're asking me 2014, I think I struggle to find a real reason for that, for the trends that we're in of developed markets outperforming emerging markets to change. Of course, I could be very wrong, but I struggle to see a catalyst for change on that.
Okay. Now, one thing you got right last year certainly was you talked up the prospects for Japan and said this was a market definitely to look at. Is there, and well done for that, of course, but is there anything that's similar to Japan this year that you would say, oh, that sounds, 2014, this is 2014's Japan, as Japan was in 2013?
So what Japan had for it last year was two things. It was cheap, and there was a catalyst, which was the Japanese election literally a year ago in December of 2012. And Abe was a shoo-in to win, and he had said he was going to change Japanese economic policy. So we had valuation supporting us, and we also had a demonstrable catalyst, and Japan has re-rated substantially on the back of those two factors. We still actually like Japan. When markets get momentum behind them. Now, Japan, the easy money has been made, but we still think there's plenty of money to be made. There does appear to be some inflation ticking into the system, which was one of the targets for this monetary policy. And for investors with a higher risk tolerance, we think Japan, along with the US, probably would be our favoured markets for 2014. So there's nothing as standout opportunity for us as there was last year, but we still do think that Japan could well have another 12 plus months to go.
Now, one of the big themes that's been talked about for the last couple of years, with all the central bank interventions and repairing things, let's say, after the economic crisis, one of the big things is, of course, the search for yield and how difficult that has become. Are there any places where investors could look where they might find yield in their search?
Yeah, I mean, yield is just so important. Cash rates are just at historic lows. In fact, if you take into account inflation, since interest rates in the UK went to their lows, £100 worth of asset would now only be worth 91 in terms of buying power today. So cash is very difficult. We've discussed bonds. We don't really find a huge amount of value in bonds. You can get some yield from equity still, and we think that would be a reasonable place to be. But something which has come on our radar more in the last 6-12 months is a sort of commercial property again. If you can get a yield of 4%, and there are a couple of funds out there now that do yield that sort of level, we think actually that for an income point of view, we don't expect huge capital returns, and investors would need to be mindful of the gating of funds where you couldn't get your money out in the financial crisis because the funds just shut. But I don't think that's imminent. I think apart from the London property boom, commercial property's had a quiet few years, and if you could get a 4% yield, you might get a total return of 6 or 7 in the next 12 months. And given that equities are not the value that they were, we're not massively keen on bonds. Cash is just terrible at the current rates. We think commercial property could be a nice diversifier.
Final couple of questions, and something that will be on a lot of investors' minds, and talking about income as well. Now, if you're still invested in Invesco Perpetual's income and higher income funds, sort of what should you be doing? Should you be considering a move, do you think?
Well, this is probably the toughest question, certainly of 2013, and depending on exactly what Neil Woodford does next, will probably be the leading question for 2014. Invesco have got a very strong UK team. Mark Barnett, who is taking over those funds in May, is a very good, top-rated fund manager in his own right, but he's running a much smaller pool of money, sort of around £1.5–2 billion. He's about to get given a £20 billion franchise, which is also likely to be in redemptions where actually people are selling out of the fund. So getting given a massive fund at a time when it's in redemptions, I think will make it difficult for Mark. So I think he's got a really tough time ahead, even though he's a very good fund manager. But the reason that those franchises are so big is because Neil Woodford has done so well for investors for a very long period of time. And if he launches a broadly similar fund at Oakley Capital, which was announced yesterday where he's going, although we don't know what he's going to do, but if he does launch a broadly similar UK mandate with an income focus, you can see a vast number of investors switching to that franchise. And it would be very difficult to dissuade them otherwise, even though Mark Barnett, who's taking over, is a good fund manager. Neil Woodford is the guy who built that 25-year track record and made a lot of people a lot of money. So I think a lot of people will follow him.
Okay, and what about the other choice in the market if people were looking for other alternatives as well? Is there a reasonable spread of fund managers who can do something like Woodford? Or
There are some managers very similar. There's a fund manager called Michael Clark who's at Fidelity. He runs a very similar defensive anti-bank favouring pharmaceutical type portfolio. Obviously, there's Adrian Frost and Adrian Gosden at Artemis. Their fund's getting quite big now as well. They've taken a lot of flows, both before and after the news about Neil's transfer. One which I think is quite interesting is Jupiter. They had a change of manager at the start of last year. A guy called Ben Whitmore's taken over. He's got a very good track record on the Jupiter Special Situations Fund. He is also a value contrarian manager, has had a pretty average first year on the income franchise, but he's got a good long-term track record, so that might be one for people to think about. Small cap income funds have done really well in the last 3 or 4 years, in fact last 5 years, and there's a Marlborough multi-cap income fund which is predominantly small caps. That might be another one for people to consider for diversifying away from sort of large cap income stocks.
Plenty of food for thought. Thanks very much for speaking to Mindful Money.
Pleasure.